Okay. So good morning. Last time we were talking about, essentially, we were talking on the section of securities brokers and dealers, and we were speaking of mainly, or we started on margin trading and short selling, right? So we finished off the margin trading section, and the important thing to understand here in the margin trading section is that why do you do margin trading? Because investors want to leverage, right? When do investors do margin trading? When they want to leverage. Why do they leverage? Because they can get better returns, higher returns, or they have the potential to get higher returns from a lesser amount of money invested, their own equity, right? So if you leverage, what is the concept of leveraging? Leveraging is borrowing money and investing more in securities in order to get a higher return. But of course, you can go wrong if share prices or securities prices come down. Now, leveraging concept doesn't mean be there only in shares. It can be in bonds. It can be in derivatives, right? Anything that you can think of, you can have the concept of leveraging. How do we go about leveraging? We have to borrow money, right? So how do we do that? In shares, we can do that through margin trading, where we borrow money from a broker, right? Where they give us a margin loan. Now remember, the term margin means your portion of the investment. It is not about the margin loan component. It is your portion of the investment, right? So when we talk about margin, we're talking about your investment as a percentage of the equity portfolio that you're buying, right? So your investment as a percentage of the equity portfolio value. So based on this, we had concepts of initial margin. That is the first component, right? As soon as you open the account or as soon as you want to borrow this loan, how much equity should you infuse? That's the initial margin. Then we said, if like you expect the share prices go up, not a problem, right? If share prices go up, not a problem, then you're going to make high profits, higher than just investing without leveraging. You're going to make higher profits and you will come out with a better return. But the problem for the broker is, as he is a creditor to you, he is lending to you, he is at risk. And he is at risk when stock prices come down, risk of not being paid back, default risk, right? And he's at risk when stock prices come down. So because of this, brokers will always have, margin lenders will always have maintenance margins. Maintenance margin is essentially the minimum amount of equity that your portfolio can go down to, right? Your equity contribution, what is the minimum amount it can go down to before you get a margin call? That means the broker calls you up, the margin lender calls you up and says, not enough money in your account, put more money into your account, right? And that amount of money that is required to bring your equity back to initial margin levels. This is what we call variation margin. And in this, we spoke about the concept of T accounts, which we use to make life easy for us, right? And whether it's easy for you or not, in your exams as well, sometimes you will be asked to draw the T accounts, right? Your asset and liability position, in terms of the assets in your portfolio versus liabilities in your portfolio, your position in this margin trading exam, right? So in margin trading, remember, what are your assets? What do? You borrow money, right? You borrow cash. You take that cash and you buy shares, right? So when you buy shares, these shares are held by you. You're the owner. So this is your assets, shares, your share portfolio, right? This share portfolio, remember, is a variable, it's variable, right? variable value. Why do I say it's a variable value? Because your share prices, depending on your value of shares, go up and down depending on the current share price, right? So the asset side is a variable value. Then on the liability side, you have borrowed money. This is a fixed value. It will never change until you pay back that borrowing. You have borrowed money, that capital needs to be paid back. So no matter what the price of the shares, that is a fixed value. Okay. And then equity is how much you can take home. Initially, equity is how much you bought into the equation, right? Meaning when you wanted to borrow money, the stockbroker said, or your margin lender said, you can borrow money from me, but I need you to put a portion of money as well. That's the equity initially. Then afterwards, as the days go by, until you pay back the borrowing, this equity amount is also variable. Why is it variable? Equity is the amount that you can take home, remember? It's your money, right? So your money that you can take home is variable because always this balance sheet must balance. Asset side must equal the liability side, right? So if the shares are variable and the borrowing is fixed, how do we get the remainder component from equity? Yeah. And this equity as a portion of this share portfolio is what we call margin. Right? So remember, in your margin trading, and I'm saying this just for exam purposes, in margin trading, when you look at your T accounts, you will have three components in your T accounts. Your asset side will have the shares. Your liability side will have your borrowings plus it's liabilities plus equity. So liabilities will be your borrowings, and then you have your equity. Okay. Now, that was on margin trading. Any questions here? Then we talked about short sales. We talked about the concept of how margin trading helps us make profits when share prices are rising, right? When share prices are rising, I can make profits on my own, or I can amplify or enhance that profitability by leveraging or margin trade through margin trading, by leveraging through margin trading, right? But short selling is the way that we make profits when share prices are falling. In a falling share price environment, what happens? Even if I don't have the share, if I can sell it now and share prices are falling, if I can sell it now and buy back later, I can still make a profit. Right? So this is what we mean by short selling. In a nutshell, I'm trying to make a profit in a falling market by selling shares I do not own. Okay. Now, these shares, if it's naked short selling, I don't own at all, right? All I'm doing is I'm in my system, in the stock exchange system, not the Colombo Stock Exchange, but in any stock exchange system where naked short selling is allowed, you'll be able to just sell shares, right? You'll be able to just sell shares. And whether you own it or not, your account will simply show a negative balance. And later on, you can buy those shares from the market and replenish it, right? Now, the problem is in most jurisdictions, naked short selling is not allowed. It's illegal because you're selling shares you don't have, right? It might be a position where you're selling more shares than there is in the market and then how do you buy it back, right? So because of this, naked short selling is not allowed in most jurisdictions. Versus what we have is what we call covered short selling. Covered short selling. In covered short selling, we don't have the shares, we don't own the shares, but we borrow. We borrow the shares that we're going to sell, right? So in covered short selling, we borrow the shares, usually through a broker, borrow the shares, sell that borrowed shares, and now I have a borrowing. What have I borrowed? I have borrowed not money, I have borrowed shares. I sell those shares and I buy it back later. Buy it back. When I buy the shares back later, I have to give those shares. Why do I buy it back later? Because I have to give those shares to the broker. Right? So here also there is a risk to the broker. The broker has lent you shares and you have sold those shares, right? You have given it to another party, a third party. And if you don't buy it back, the broker is at risk that he'll never get his shares. And highly likely, the broker didn't lend you his own shares. The broker lent you somebody else's shares, highly likely, right? So then the broker is at risk to be able to pay back the other person. So because of this, the broker, when you sell the shares, will not let you take that money, because when you sell the shares, you get money, right? He won't let you take that money home. He will keep that money with him as a safeguard. Until you give him his shares back, that money will be held with him as collateral, right? So once you sell the shares, so what do? You borrow shares, right? You borrow shares and sell it. The money is kept with the broker as collateral. Okay, the money that you get the sales proceeds, broker keeps it as collateral. He doesn't give it to you. And when the share price comes down, what will you do to get your money back? You'll buy the shares from the market, give the shares back to the broker, and the broker will give you your money back. That's what happens in short selling. And this is essentially the concept of covered short selling. Covered short selling. Right? We said last time that the broker is still at risk, right? Broker is still at risk that he may not get his shares back. Not get his shares back. So because of this, the broker doesn't give you your money. But we discussed last time, if you remember, that just because the broker has your money from the sale of shares, he is not safe. He is not safe. Because in short selling, what is the risk? In short selling, where is the risk? What is the risk to the broker? Or how is the risk to the broker? When will it manifest?
Share prices goes up.
Share prices go up, yes. When share prices go up, the problem is you've sold shares you never had. Now you had to buy it back at higher share prices. You have very high propensity to default, right? Very high probability of default. So the broker, now imagine you defaulted. The broker has your money because you sold shares. Let's say, in my example, let's say you sold shares at 100 each and you sold 1,000 shares at 100 each. So the broker has 100,000 with him. Okay. So when you sold the shares, when you borrowed the shares and you sold it at 100 each. You were waiting for the share prices to come down to buy it back at 50 or 80 or 90 even. But share prices didn't come down. No, share prices have gone up. And let's say share prices are 101 rupees. Not much, but they've gone up, right? You borrowed shares from the broker. You've never seen the money that you sold, right? The broker has kept it. So there is no incentive for you. You can think, okay, the broker can buy the shares back from the market. He has my money. He can buy it back from the market, right? So you can default. I mean, there is high probability or high propensity, right, for you to want to default. If you default, now look at the broker's position. When you default, he has to buy the shares back from the market. He has with him your 100,000 rupees from your share sale, original share sale, right? But is that enough for him to buy the shares back from the market? You have borrowed 1,000 shares at 100 each. Now, when he needs to buy it back from the market, he has the cost to him is 101,000. 101,000. He only has 100,000 of your money, right? Now he out of pocket for lending you shares, he has to put in 1,000 rupees more to buy these shares. That's not all. That's not going to happen, right? So because of this, I hope you understood that. So because of this, what will the broker do? The broker will say, me keeping your money is not enough. I have to have something additional to make sure in case the prices go up from these levels. I have enough money to buy back the shares when you default. So because of this, there is an initial collateral that will be requested by the broker as well. In addition to keeping the money that belongs to you from the sale of the transaction, he will request an additional collateral, which is what we call the initial margin. It's still your equity, your money. Your initial margin can be in the form of cash or cash-like securities or even equity if the broker accepts it, right? So he will request additional collateral. Additional equity that says, okay, 50% of the value of the sale, you have to deposit. Okay. So now you have deposited an additional 50,000. So the broker with him has 100,000 plus another 50,000. This 50,000 might be in the form of cash-like securities, or if he accepts it, even equity, right? So you deposited this additional 50,000. Now, when the share price goes to 101, you have no incentive to default because the broker has 150,000 of your money. If nothing else, if you don't even know about this 100,000 or you never seen the light of day of this 100,000, he still has 50,000 of your money, right? So you have little incentive to default. Actually, at 101, you probably will not default. When will you have incentive to default? If share prices go very high, it keeps on going to 130, 140, 150. Now, to buy it back from the market above 150, anyway, you're going to lose this 50 also. Right. So then there is little incentive for you to pay back the broker his shares, right? So therefore, which is why even in short selling, you will still have the concept of maintenance margin. Maintenance margin, just like in margin trading, maintenance margin, what will happen? The broker will say, okay, your equity in your account as a percentage of the value of the shares that you owe me, the broker, equity as a percentage of the value of the shares you owe me. Remember in margin trading, what is the margin? Margin was the equity as a percentage of the value of your share portfolio. Okay. Here also it's the same thing. Only thing is now the share portfolio, actually, the shares belong to the broker, which is why it says value of the shares owed. Okay? The broker says can't fall below a certain point, which is what we call the maintenance margin. So here also you will still have the same concept of initial margin, maintenance margin, variation margin, all of these margin call, right? All of these concepts will be the same in short selling as well, right? Only thing is, the difference is short selling works on the opposite side of the spectrum to margin trading. Margin trading, the broker is at risk when share prices are coming down. Short selling, the broker is at risk when share prices go up, right? In margin trading, the margin is the portion of your equity as a percentage of the value of your share portfolio. In margin in short selling is essentially your portion of equity as a percentage of the value of the share portfolio that belongs to the broker, right? That you have borrowed. So short selling, actually for the longest time we didn't have it, but last year in November, short selling was introduced to Sri Lanka. So now we do have short selling that is in the market. Of course, we don't have a lot of trades that are happening in the market still. Still, a lot of brokers are implementing systems. People are learning about the process, right? Understanding the risks. So we are not seeing a lot of trades. At some point, hopefully, we will see more trading that will happen in terms of short selling. But it is now there for people to take advantage of. Okay? So this is the sum that we were doing last time. Okay. So you short sell 1,000 shares at 100, right? What have you done now? You borrowed 1,000 shares, right? Think of the process. You borrow 1,000 shares, right? And you then sell it. When you sell the 1,000 shares, how much money do you get? You get 100,000 rupees. This 100,000, although it's your money, you sold the shares, it doesn't belong to you until you give the shares back to the broker. So the broker holds it as security, as collateral, right? So the broker keeps this as security. In addition, he wants you to give additional security to make sure that if the price goes up, you don't default. Okay. So that additional security is the initial margin. There's a 50% margin requirement on short sales. Okay. Now remember, we did the first part of this example last time. Remember how your T account looked like? You borrowed shares. So what are your liabilities? Your liabilities is your borrowing. You've borrowed. But now what have you borrowed? You have borrowed shares, right? You borrowed shares. You borrowed 1,000 shares. Right now the share price is 100. So therefore, what is your liability? Your liability is 100,000. But is this liability a fixed liability? In margin trading, you borrow 35,000 or whatever. In our example, it was a fixed liability. Is this liability a fixed liability? Is this liability a fixed liability? You have to pay back the broker 100,000. Yeah.
It can go up.
It can go up or come down, right? Why?
With the change in price of the share.
Yes. Because the price of the share changes. So this liability is a variable liability because your share price can keep on changing, right? So your borrowing is not a fixed borrowing because your borrowing is shares. So what is your liability? The liability is to repurchase the shares, right? So your liability keeps on varying. It's a variable liability. And then on the other side, so you borrowed shares, you sell the shares, and you've got cash. That cash is held as security with the broker. That's a different thing. But the cash is an asset to you. It's an asset to you, right? So you have 100,000 of cash that comes from this transaction by selling the shares. This 100,000, is it fixed or floating? Variable. Fixed or variable? This 100,000 on the asset side, is it fixed or variable?
Fixed.
It's fixed, right? Yes. because it's cash, right? It can't vary with anything. It's cash. So your asset is cash and you have 100,000 in cash. It's held with the broker as collateral. You've given it as collateral, but ultimately it's your money that the broker is keeping until you pay him back, right? When you give a land or property as collateral for a loan, doesn't mean that it's not your asset. It's still your asset. But once you pay the borrowing, you get your asset back. But ultimately it's your asset, right? So like this, the cash is held with the broker. It's your money, but held until you pay the shares back. Now, your assets and liabilities here match. You can see it's 100,000 on the asset side, 100,000 on the liability side. But it's not the end of the story, because just because the assets and liabilities match doesn't mean that this story is complete in terms of the T account, right? Why? What else is missing here? What else is missing? Nothing else? Sorry, go ahead.
Equity.
But equity is zero to account to this. You're right. But how? What is my equity?
Additional cash.
Additional?
Cash as a collateral.
Yes. The fact is, the broker says this cash that you kept as collateral is not enough, right? He will not accept only this cash as security. He wants additional security. This 100,000 is security, but he wants additional security. That's why he asks for a margin. So that additional security, 50% of the share portfolio that you owe. So the share portfolio that you owe is 100,000 right now. So 50% has to be kept as margin. Additional securities have to be bought in. So that means on the asset side, I have to give the broker as collateral any additional assets that I have. That might be cash or shares, other shares, right? Not this share, other shares or cash-like securities. Cash-like securities. 50% of the value of this portfolio, 100,000. So 50,000. That's additional collateral. Okay. That I have to keep with the broker. So technically, if I keep cash, that collateral also doesn't change. If I keep equity, of course, the collateral values will change. So that is now on my asset side, I have assets of 150,000. My liabilities and equity should add up to 150,000 as well, which means my equity, which is right now, is 50,000. What is that 50,000? It's the additional collateral that I bought and gave the broker. That's my money that I can take home. Okay. So that's essentially my T account, the initial position of my account. Any questions here? Right. Then we did the second part of the question. What is the profit if the stock price falls to 60? That's easy enough, right? That's easy enough. When I sold it when the stock price was 100, I sold 1,000 shares. I'm now buying it back when the share price is 60. I'm buying back 1,000 shares. So what is the profit that I'm making? 40,000. When I sold it, I get revenue. When I buy it, I have a cost. What's the difference? That's my profit, 40,000. Any questions there? Okay, so this is where we were. Next part, what's the answer? Draw the T account. Do it through the T account. 1, it's easy. 2 is for practice, right?
India, the margin is always on total asset value.
It's on the value of your share portfolio. Your share portfolio is not the collateral that you have given. It's the share portfolio of the value that you have borrowed.
Okay. Thanks.
Actually, I always keep meaning to change these two questions around and I never do. Can you try question number 4 first before you try question number 3? For some of you, it might be a little less confusing. Try question number 4 first. Same thing. Try 4 and then we come to 3. What's the answer for 4? I think some of you are good at done this last week. Where's your chat window?
I don't think there is one for this.
Yeah, that's very unusual, no?
Yes.
I don't even see any control for me to enable the chat. That's fine. Anyway, that's fine. We'll figure it out during the break. So for the moment, no chats enabled. If anybody knows how to change this, let me know, please. So how do we go about this? How much is the margin for question number 4? If I write the T diagram, what does it look like? My borrowings, what do they look like? On this side, I had cash. What does that look like? It doesn't change. Yes, cash remains at 100. Because it's cash. Cash can't change, right? No matter what happens to the stock price, it can't change. I had other collateral. What happens to that? That also remains at 50. That also doesn't change. I mean, if I had other types of equity, maybe the collateral values change, but that's not complicated. This question doesn't have that, right? So it's cash like instruments. So neither of these have changed. On this side, on the liabilities plus equity side, what happens to my borrowings? Sorry, 110. Yes. Now I have borrowed 1,000 shares, right? I have not borrowed 100,000 rupees. I have borrowed 1,000 shares. Now each share is worth 110. So therefore, my liability is now 110,000. That means I have to buy 1,000 shares from the market, paying 110 rupees each, and spend 110,000 to buy these shares. That's my liability, right? Therefore, how much is my equity? Equity is the balancing figure for both sides to be 150. That implies to me that my equity contribution is, or not my equity contribution is 50, but now my equity take home is 40. Right? So what is my margin? What is is it 40%? It's margin. The equation is equity as a percentage of the value of the shares owed. Right. So equity as a percentage of the value of your share portfolio that you owe. So your equity is 40. That's correct. What is the value of your share portfolio? Value of the share portfolio that you owe, not your share portfolio. 110, yes. 110,000. So how much does this come to? 30?
36.36.
36.36, okay. That's his margin, right? Now take that concept, think that stock price is X. Don't think of it as how far can the stock price rise. Think of it as what will be the stock price before he gets a margin call. How far is the difference now? What will be the stock price before he gets a margin call? So draw your character diagrams and then put it to the equation. Maintenance margin is 30%. No, draw your T diagrams. Yeah. So now what does it look like? Cash, cash,
100,000.
100,000. Doesn't change. Collateral,
50,000.
doesn't change. Borrowings,
115,384.
that's because you found the answer, right? So here, when you write your T account, take your share price to be X. So what are your borrowings? Your borrowings are 1,000 shares. into X. How much is your equity?
$150,000 minus 1,000.
So then, what is your margin? We know that the maintenance margin must be 30%. Maintenance margin must be 30%. But it's also equals to equity. Equity is 150,000 minus 1,000x divided by value of your share portfolio that you owe, which is 1,000x. So therefore, how much is x? 100. Who's had the answer, no?
115,384.6.
X is the share price. So 115.38.
38.
So if your share price rises to 115 rupees or 115.38 rupees, after that point, you will start to get a margin call. Margin call. Any questions here? So in short selling, so that's essentially the concept of short selling, right? Now, in short selling, one of the problems that happen with short selling is that when you short sell, you're expecting the market to come down. And when do you short sell? When the market is too high and you're expecting the prices to come down. But I hope you understand when prices are coming down, people will short sell more, right? Because they see prices coming down. So on a bad market, short selling can exaggerate the decline in price. Short selling can exaggerate the decline in price. Okay. So this is a problem that we have with short selling. It's the same with margin trading as well. In margin trading, in a upward trending market, in a market that's too low and it's going up, margin trading is where you're putting more and more money to the market and buying more and more shares in the market, right? So you can exaggerate the upward price movement. Nobody cares about that, right? But when market prices are coming down and more people are selling because more and more people are short selling also, borrowing shares and selling, and actual people are selling, it can exaggerate the price downward move. Can exaggerate it, right? That we care about. So because of that, in short selling, we have what we call an uptick rule. Can have. Some markets will have what we call an uptick rule, where it says you can't do short selling unless, right? You call it an uptick rule or plastic rule. Always the sell must be conducted at a price, the sell order must be at a price higher than the previous trade. Higher than the previous trade, right? So what will happen in the short selling, the market keeps on coming down, right? It doesn't come down like that, no. It will come down like, it will come down like that. So in an uptick rule situation, if your last order was, the price was 100, you can't now put a short sell at 90, 99, right? In a normal short selling situation, somebody sees the prices coming down, right? They will start putting, okay, I'm putting my price, I'm selling at 100. Another person will sell at 99. Another person will sell at 98. Another person will sell at 97. Now, what will happen? You borrow, and sell. Market price coming down won't stop because everybody's selling, right? Essentially, it can come down quite a bit before people start to buy it back. So, to avoid this situation, you have an uptick rule that says if somebody already did a trade at 100, right, you can't, the next trade that goes through, if it's going to be through a short sell, if it's a normal sell, that's not a problem. But if it's going to be a short sell, it has to be at a price, you have to quote a price above 100, the last traded price, right? So you will quote 100.10, right? And if your quote goes through, then at 100.10, there will be a short sell. Now, what will happen in this situation is the next person short selling will have to quote a price higher than this, 100.20, right? And the next person short selling will have to quote a price higher than this, 100.30. Now, what happens? People see, okay, uptick rule fine, but people start to see, okay, stock prices are coming down, but now it's stabilizing. So then the other short sellers take a breath, right? And therefore, that exaggeration doesn't happen, very quickly. So then what happens is people will wait to see, okay, is this like short sell? Is this like, actually price coming down? What is the reason for the price coming down? So because of this, the uptick rule is there to make sure that the market stabilizes or doesn't free fall, right? So it just doesn't mean that the uptick rule will stop short selling. It simply means that it could be a situation where, for example, it can happen. You put an order at 100, actual sale, right? Actual person puts a true sale. He owns the stock, he owns the share, and he puts an order at 100. Now, the short seller can't put an order at 100 or 99.9. The short seller must put an order one tick size minimum above. So he puts an order at 100.10, right? At 100.10, let's say that sale goes through. The next short seller must bid at 100.20. But before that, if somebody, an actual seller, not a short seller, an actual seller comes and the stock price falls again, then the next short seller will have to put at one tick above that price, right? So doesn't mean that uptick rule will necessarily stop market falling, but it will reduce that speed of market falling, right? So because of this, uptick rule is there. And even in Sri Lanka, in our short selling, we have what we call the alternative uptick rule, which is practiced in some countries, where they allow you to short sell without a problem as long as the market is falling. If it falls more than 10%, if the price of a certain security, right, when the share price declines by 10%, then you are not allowed to short sell anymore without an uptick. From that point onwards, you have to wait. You have to always quote, the short seller must always quote a price higher than the last trade. That's what we call the uptick rule. Any questions here?
On this trading platform, so when this is happening, is it visible to the others that
Yeah.
someone shorts it?
Technically, you're supposed to, there's a tag that is supposed to say that it's a short sell. So it's got to be tagged. So I haven't seen when the trade goes through whether that tag appears or not. I haven't seen it because very few trades have gone through. Anybody else who's seen the trade happen can please let us know whether you see the tag. But certainly after the trade, when you're displaying it, the tag should appear.
That's here.
Yes, that's here.
That's on the trade. No, not on the order.
Okay, let me check that. Let me check that and come back. I'll tell you after the break because I can't remember whether it's on the order book or you have to mark it as a short sale. That I can't remember.
Okay, thank you.
Other questions? Okay. So another problem that can happen with short selling is what we call the phenomena of a short squeeze. Now, short squeeze doesn't happen unless you have a very high number of short puts, a very high number of short sales in a particular share, right? When a particular share has a high number of short sellers, very high number of short sellers, right? That means everybody or a lot of people expect that this share is overvalued, and a lot of people have taken positions on this share and is expecting the share price to come down. But let's say some good news comes about this share and the share price starts to go up, or something, some other phenomena happens and the share price starts to go up. Now, when share price starts to go up, all these people who are holding positions, short positions, suddenly become at risk because they are at risk of getting a margin call and the broker say, not enough money in your account, come and put more money into your account, right? So what will start to happen? So these people will start to unwind their positions, meaning they will start to buy back the shares, right? Buy back the shares from the market. Because how do you unwind the position when the share price, ideally when the share price is coming down, you want to sell it now and buy it back later, right? But now let's imagine you were waiting for the share price to come down, but the share price starts to go up. And as the share price starts to go up, you become more and more at risk of being asked to put in additional fallout. And some people who don't have additional money to put or don't want to put additional money will think, okay, they want to unwind their positions. Also, when you have so many short sellers in a certain share, right, everybody will want to be the first person to get out, right? Because the more and more you wait, the more at risk that you become, right? So because of this, what will happen is when the share, for some other fundamental reason of its own or something like that, or other technical reason, starts to move up, you will see all these short sellers now might start to panic and start to buy back the shares. They are buying at a loss. For them, it's a loss because they wanted to buy when the share price came down, right? But now they are buying, share prices are going up. So what are they doing? They are getting out of, they're exiting their positions. They're exiting their positions, right? To make sure no further losses. Or it could be that the brokers are selling it because they've made margin calls, right? They made margin calls. Not enough people are not coming and putting more money and they're selling in the market. Just like, when you have margin buying, and when share prices in margin buying, you want share prices to go up. But when share prices come down, what do you see? Brokers make the margin call. If people don't come and put more money, they will also start to sell. And it exacerbates the downward movement of the market. Same thing here. This exacerbates the upward movement of the market. In a short squeeze, short sellers themselves create a phenomena where they're actually increasing the price of the share without letting it decrease, right? Without letting it decrease. So very recently, you saw a short squeeze happening in companies like in the US, you might have heard of this GameStop saga, the GameStop phenomena, which is GameStop was a video gaming company, right? Towards the end of its life cycle, because, video gaming was going out of, the type of video gaming that they were offering was going out of style, right? So this was a company that was failing essentially. And there were a lot of short sellers in this company. There were a very high amount of short positions in this company. And then what started to happen was we had a few retail investors who are coming up with theories about the company, right? A lot of the time, like you see in Sri Lanka, our WhatsApp groups and our Telegram groups and so on and so forth. They have their Reddit groups, right? And in those Reddit forums, you saw a lot of saw a few people coming in, few retail investors, small scale coming in, who started to say that this stock had value. The board changed, they got in a new CEO, there were things that they were doing to revamp the company. And with that, they start to say that stock had value and you should buy. And with that buying, what started to happen, all these hedge funds, these big investors who had taken short positions, there's a lot of the time, short selling is not for retail investors, right? A lot of the time. So Sri Lanka has not made that distinction per se, as long as the broker is okay with it. The retail investors are allowed, and actually Sri Lanka, with large scale investors or with high net worth, not high net worth, sorry, institutional investors, certain institutional investors, by their mandates are still excluded from carrying out short sales. So anyway, in GameStop, this people start to buy and you start to get margin calls. And there was a point, I mean, there were many things that happened, right? So to avoid these margin calls, there were some unethical practices that happened. For example, some of these margin trading houses, like suppliers, like if you all have heard of Robinhood, right? These guys essentially stopped or froze accounts. Working with the hedge fund managers, they froze accounts of all these retail investors who were buying the share. So like with a lot of these things happening, GameStop actually increased in price. It increased in price by about from $2 to the share to about $180 to the share, or $280 to the share, something like that. Okay, so you can imagine from $2 to the share to increase to like whatever the price, $280 to the share or something like that, or $400 to the share. I can't remember exactly. Imagine that price increase happening within a few days or a few months, right? So in a very short period of time, especially the last few price jumps happened within a few days. The how much the hedge fund managers who were shorting would have how much trouble they would have been in, right? So in that sense, there were a few hedge fund managers who essentially had to unwind their positions. Now suddenly I can't remember if they had to declare. No, I think, but like they went through really tough positions in terms of unwinding. Okay, so that's what happened with the GameStop saga. So GameStop, some hedge fund managers lost like $10 billion, right? 10 billion, $20 billion. So that was massive losses that you would see that they had to go through because of short squeeze. So short squeeze is there. Short squeeze is there when you essentially have stocks that have very high amount of short selling. Okay, that's when you will see short squeeze happening. So stocks where you have very high component of short selling. So you should always, if you're looking at short selling and thinking of short selling, as a short seller, you should also observe the short interest ratios or the short interest, right? Essentially, how many shares have been sold short as a percentage of the total shares outstanding of this company that you're shorting, or the short interest ratio, meaning the total number of shares sold short for against the average daily trading volume. Right. So 2021, you saw this GameStop saga. We thought it was pretty big, right? And we saw a lot of hedge fund managers going through really bad times because of their positions margins being called. But actually, one of the largest short squeezes happened in 2008 during the global financial crisis with Volkswagen. So with Volkswagen, you know, the car manufacturer Volkswagen, they were a company that was actually going through a really bad time. Anyway, they were going through a bad time. Before 2008, they were going through a really bad cycle because they were a highly leveraged company. They had a very high amount of debt. And then 2008 was a global financial crisis. Remember, we talked about the securitization, how like the housing market slumped, people lost their jobs, like, so many things were happening. Global financial crisis was happening. So imagine that's the worst type of business cycle for vehicle manufacturers, right? I mean, you're going to cut back on luxury goods, or you're going to cut back on non-essential discretionary components, right? So this is the worst type of cycle for vehicle manufacturer as well. So Volkswagen had a lot of short sellers, who were expecting or looking to profit from prices coming down. The short interest on this company was very high. But this company was owned by Porsche as well as the German government, right? So you can see here like 44% owned by Porsche and 20% owned by German government. So it had a very small free float, what we call, that's available for public trading. And in the middle of this, during the global financial crisis, Porsche decided to increase its ownership. So they, through call options, they purchased a further 30% of this company, right? So now imagine Porsche has 44 plus 31%. So that's 75% of the company. And then the government has like another 20%. So nearly 95% of the company is closely held, right? Strategic investors. Now the free float is 6%, right? Now Porsche didn't disclose that they were buying. They were essentially accumulating the share. They accumulated and then made that disclosure, right? And they accumulated through call options. So it was not that people saw them accumulating through the market. They were buying call options and then decided to exercise the call options. And for those of you who are, we will talk about call options later on in a different section, right? And we'll refer back to this example there again. So they are accumulated through call options. And suddenly you found that only 6% was the free float. 6%, so like that 95% would have been like 94 point something or something like that. So less than 6% of the market was free float. Free float means shares available to the public. Now, what was the problem? There were positions taken on GameStop on borrowed shares, right? Not GameStop, sorry, Volkswagen, where 13%, there was short interest of 13%, but only 6% shares are there in the market. So you understand, when there are people who are waiting to buy shares, 13% of the shares outstanding, people are waiting to buy. Let's say to make my example easy, there's 100 million shares outstanding in this company, right? 13 million shares have been borrowed and people are waiting to buy back, right? All these hedge fund managers are waiting to buy back these shares from the market. But on the public free float of this 100 million, 95 or 94 point something million is held by Porsche and the government, and only 6 million is on the public free float. All these people who have borrowed shares, they have to buy. How are they going to buy 13 million shares? They can't. There's not enough shares in the market to buy, right? Suddenly, all these short sellers start to panic. They have to buy back the shares and give back to the borrower, but there's not enough shares to give back to the borrower now. So they start to panic, right? And everybody started to be the first to buy the shares. There was a race to be the first to buy the shares. And then what happened? From 210, within 2 days, Volkswagen jumped to over $1,000. It became the world's largest market capitalization company. The world's largest market capitalization company at that on those 2 days. And there was panic in the market. And then suddenly Porsche said, no, we will sell another 5% so that the short sellers have enough shares in the market to buy back. We will sell. So what did they do? They unloaded a little bit more shares to the market so that there was enough shares now for the short sellers to buy back and give and pay back the money, right? So with that unloading, that short squeeze kind of eased out because now there was enough shares, at least there was enough public float to buy. And you can see the short squeeze eased out and the share prices fell back down. But during those 2 days, the problem is this, right? When you short sell or when you margin trade, your long-term call might be right. Your long-term call might be right. But short-term, your risk management makes you, it's not your risk management, it's the stock exchange's risk management, it's the stock broker's risk management. But your external party's risk management can create large losses and even lead you to bankruptcy. Here, one of the biggest short squeezes in history, hedge fund managers lost over 30-40 billion. It's actually bigger than GameStop. And when you take inflation into account and everything, it's a much bigger short squeeze than what happened in 2021, 2 years ago with GameStop, right? So these are the types of problems that can happen. And these are because of short-term phenomena. Risk management by different parties may mean that your theory, even though it's right, even though it's true that Volkswagen prices should come down, it's highly leveraged company, bad business cycle, everybody was going bankrupt, right? And short sellers were right in the long term, right? This company was not going to perform well. They should have made money. But because of the short-term phenomena, they lost billions. If you remember that hedge fund that we talked about, where Black and Merton worked, right? ATCM, and which spoke about how, Enron collapsed and the credit cycle where they were expecting this to close actually went the other way around, and the margin trading costs got exaggerated and the short sale costs got exaggerated, and from both sides they got hit and they had to close down the fund. It was a short-term phenomena, right? But they went bankrupt. They had to be bailed out, right? If they had been allowed to wait it out, they would have been right. Their call would have been right. They would have made money. But that short-term cycle, it was not that they were wrong that made them lose money. It was the risk management of other parties that made them lose money. Same way in Volkswagen, same way in GameStop. GameStop ultimately collapsed back down, right? The company didn't do well. It wasn't justified. The price increase wasn't justified. Short selling, ultimately, if they were allowed to wait through that cycle, they would have been right. But in between, there were margin calls, and they had to make those margin calls. And because of those margin calls, they had to unwind their positions at losses. And that's the risk that you're taking when you do margin trading, when you do short selling. Any questions? Okay. So,
Yes, we don't have that Volkswagen slide.
no, you don't. That's just it's just an example. I just put the numbers so that I remember the numbers. That's all. If you want to, I'll put it up. I'll put it up and I'll send it across again, the slide separately. Sure, definitely. Yeah. Absolutely. So there are allegations against even the regulator in terms of how the case was handled. A lot of the time, what you will see is, and you see that happening here, right? It's the same way that it happened even in the US. You saw a lot of where money talks, and the way that the regulators handled it was also not on the side of the retail investors, and so they took more time than required to ask I think companies like Robinhood to stop that freeze in assets to get them to trade again. So there were some unethical practices that were happening there as well. Yeah, absolutely. So that's a good if you get a chance to watch it, the GameStop saga. That is a good documentary to watch. Hope the name is correct. So if you get a chance, see if you can get it. GameStop saga, not the GameStop name. Saga. There are a couple of documentaries and movies that have come up on this GameStop. So that's actually a very good one to take a look at if you all have time. So Sri Lanka, last year when they introduced short selling, I mean, you can't do this without the ability to borrow as well, right? So it's not just short selling that they introduced the concept of stock lending and borrowing. We call this SLB. So they introduced two concepts: regulated short selling and stock borrowing and lending, stock lending and borrowing, stock borrowing and lending, right? SPL and RSS. So short selling with stock borrowing. That's how it goes. To be able to short sell, you should be able to borrow the shares. So that's what is facilitated by the lending mechanism, right? So in the lending mechanism, typically you will allow any party, let's say high net worth individuals, institutional investors who want to lend their shares for a short period of time. They enable the mechanism to be able to lend the shares to the market, right? So now we are able to, if I have shares in my portfolio, my individual portfolio, and if I have a SPL agreement with my broker, I can lend those shares to the market. I can put up a notice saying that I'm going to lend these shares, and I can say that what rate do I want to lend these shares and for how long I want to lend these shares. And based on that, if somebody wants to borrow these shares, they can borrow these shares and go and then do their short selling transaction. So when I put that I want to lend these shares for a certain period of time, that is the day that they have to return the shares back to me, right? So technically, if you want to do regulated short selling, essentially borrowing and selling these shares, the short seller has until the date that I have given them for the shares that I have lent out, until that day to return my shares. So they have until that time to execute their strategy. So they can borrow these shares, sell it in the market, and they have this period of time before, let's say I've given them time till 31st of December 2024, right? This is the day I say I want my shares back. So until that time, they have time for the share price to fall and execute their strategy. In between, of course, broker will have, because broker will lend on behalf of me. So broker will have his own safeguards in terms of the margin lending, all of that. The broker will be the one who will look after all of those, right? So if there are margin calls and all that, and the stock borrowing lending transaction will happen. And on this date, whichever way, either the short seller has to come back through the broker and ask me whether I can extend the time period that I have lent these shares for, or they had to sell these shares in the market no matter what the price and give the shares back to me. So it allows institutional investors as well as retail investors to make something out of their ideal share portfolios, right? So you have share portfolios. Sometimes people have their share portfolios and they, some institutional investors don't, it's buy and hold portfolios. They don't engage in high frequency trading. Some investors will engage in high frequency trading, then it's not for them. But for some investors who just, they are not strategic investors, but they are waiting for something to happen in terms of they are buying the shares. So obviously, they are waiting for the price to go up, and they're long-term holders, right? These types of investors can make an additional return on their shares by lending it out through the stock lending process, by lending it out, and they will earn a return from it. Now, in Sri Lanka, there is a small, stock exchange is working towards fixing this, but so far, the way it has been introduced, there's a small edge in terms of the money that you earn from the stock lending process. So, say for example, I give my shares from today to the 31st of December, right? So, I want my shares back on the 31st of December. I've lent it out and I've given a certain rate of interest. Let's say I've said I'll lend these shares out at 12%. So, what is the rate that I should get? What is the return? How can I put it? What should be my earnings for the portfolio that I lent out? It should be the value of the portfolio each day, should be calculated daily value of the portfolio at the end of each day, and then 12% on that, 12% divided by 365, obviously for a day, but 12% on that, right? That is not how the calculation goes right now because the system can't facilitate it. They're working on it. Right now, the calculation goes at the end of the period, the value of the share portfolio, that means the value of how many shares I've lent out. Let's say I've lent out 1,000 shares into the value of my share portfolio. Let's say it's 100 on 31st of December. On this 100,000, I will be paid 12% into the number of days that I have lent out this portfolio. Technically, it should not be that. It should be based on the weighted average, right? But at the moment, this is how it goes. Now, the problem is, obviously, if somebody is short selling the shares, they're borrowing these shares to short sell. You understand they are not expecting the share price. I mean, they can be wrong, but they're not expecting by 31st December the share price would have gone up. They're expecting by 31st December that the share price would have come down. So the lender is at a disadvantage there. If the borrower is correct, then the lender is what? Is earning at the lowest price, right? His returns that he will earn will be based on the lowest price. So that's why we say, to be fair, it should really be based on the daily price movement, the daily balance, meaning the weighted average price. But this is something as we go along, I'm sure will get fixed. But if you look at other countries, how will this lending earnings be? It will be based on the daily balance. So there is a question on the stock lending and borrowing in last year's paper or the year before. I can't remember which paper. I think last year, but it could be the year before. You can just check it out and see. Yeah. Okay. That's right. Yeah, I mean, if you borrow the share, that's what you're talking about. You're the short seller, right? Yeah, I mean, the risk for you is still in terms of the margin. The risk is in terms of the margin, right? I mean, if you get a margin call or not, you can wait, but your broker will not allow you to wait if it falls below the maintenance margin. So if your share price rises more than the maintenance margin, then you have to put additional money as collateral. So that's where your risk is. Or otherwise, the broker will buy back the shares from you. He'll take it out of your portfolio. He'll buy back the shares and he'll return it. He has the option to return it early. So if you go to the stock exchange website, you'll see there are FAQs in terms of the short selling, stock borrowing and lending, what it is, the uptick rule, right? So the regulated short selling and stock borrowing and lending, right? What it is, how it gets transferred, all of these are there on the stock exchange website. The link has been given to you as well. Then if you come here, I hope you all can see my screen, regulated short selling and borrowing, right? You can see the active lending and borrowing orders for the day. So at the moment, nothing, no data available, right? No active borrowing or lending orders. Sorry, no active borrowing orders, but there is lending. So you can see here, people who have put orders to say we are willing to lend. So Haley's 13,000 is up available to be lent at a rate of 12%. We have to return it 8th of November, right? Like this, Access 666 shares available to be borrowed. I don't know why some people are putting 4% interest rate. I'm not sure whether this interest rate is, I mean, should be a per annum interest rate. I'm not sure why then the rates are so low. But you can see the different interest rates that are there to borrow these shares. I mean, in a way, it's opportunity cost as well, right? So these are the active lending, but nobody is there actively borrowing at the moment. Outstanding short positions, no outstanding short positions at the moment. Eligible securities. I hope you can still see the screen. What did we look for? Eligible securities for RSS and SBL, right? So these are the securities that you can carry out, you can borrow and short. Every single security is not allowed to be borrowed and shorted, right? So you can see there are 284 stocks in the share market. These are the securities that you can borrow and short. So obviously this is not 284 shares. This is taking into account the free float available to make sure, other risk management things like make sure there's no short squeeze, things like that. This is what is available to be borrowed and shorted, right? And remember, RSS and SBL are not necessarily coupled together. You can do borrowing for other reasons. It doesn't necessarily only have to be because of short selling, right? You can borrow shares from somebody else to do derivatives transactions. You see, for example, when we do derivatives, you see you have what we call equity swaps, where you can lend shares to others and do a swap based on the income there, right? So you can, this SBL being there is there to facilitate any type of transaction, including derivatives transaction, which we don't have in the stock market at the moment, but that's part of the long-term plan. So SBL is not simply there for regulated short selling. Eligible securities for collateral. Remember, we talked about the margin component, the initial margin component, the additional collateral. So these are the securities that you can give as collateral when you're short selling. So this is what you can short sell or lend out for short selling purposes. These are securities that you can give as collateral when you short sell in addition to cash. Yeah. So let's take a break there because we finished this section. Sorry, can you remind me again what was the question you asked? on the short selling?
It was whether the system indicates
At the short sell. Let me check
short
that.
sell on
Okay.
the book or the trade.
Right. Right.
Thank you.
Thanks. So let me check that. We'll talk about that after the break. Let's take the break. It's 9:45. So 10:05.